Hello and welcome to another Smaulgld podcast. Today is August 7th, 2019. It is Wednesday, and today's topic, gold $1,500 an ounce, permission granted. Now, we have talked often on this channel about the gold-silver ratio and the direction of silver, and I resisted the concept that the gold-silver ratio was unsustainably too high and that it had to come down. And I've suggested that it has to come down or will come down if one of two things happen. There is some type of supply shock and a corresponding increase in industrial demand for silver, which hasn't happened, or if there is an increase in the price of gold, a sustained gold bull rally, then the investment component of silver, which is small, would catch fire, and given the small size of the silver market, then silver would start to rise. Well, given that we mentioned also for the past 4 years that gold has had difficulty breaking out of a $1,350 to $1,375 ceiling, that we had not really seen a sustained gold bull market over the past 4 years. We've seen fits and starts, and we've also seen during those fits and starts, silver make some fits and starts, but fall further behind gold. Now, what's happened this year so far is today gold broke the price of $1,500 an ounce, and that is significant because it was significant to break the $1,375 an ounce, which is something I said once it does that, if it can do that, it would go straight to $1,500. And indeed, we have seen that it has gone straight to $1,500. There's your chart today. A very big day for gold, closing at $1,500, up $27. And that was up 1.87%. One of the points we've made all along is that when gold goes up, silver was not going up as much. And when gold went down, silver went down even more. Well, today, permission granted. Gold has gone up, but silver has done what it should do when gold breaks out. It breaks out even more. And there you go, up 4% today, capped over $17 an ounce, went all the way up to $17.22, held over $17 for the close, and closed at $17.06. This is exactly what you want to see in a if you want silver to rise, you need gold to lead, and gold is indeed leading. Now, the other thing is, a lot of the gold pumpers and the silver pumpers have their stories wrong. The gold pumpers have been saying for years, dollar collapse, gold back yuan, China to crush the dollar. You know, the whole China story, China good, US bad. And that would mean the dollar was going to be collapsing, and then gold would go higher, and the COMEX would default. And on the silver side, you had all the ridiculous stories about JP Morgan buying silver and letting it ride. Silver shortage, none of that. Today was a big, big day for gold and silver. I would say a breakout day. And had nothing to do with dollar collapse. The dollar was not down today. In fact, the dollar has been rising the past few days. But you had very big moves in gold and silver. We've also seen the Fed nominees to the Fed, some other things that are leading to this gold price increase. Trump has nominated at least 3 people to the Fed that have gold leanings. Not one of them has been approved yet. But that really does legitimize the concept that in official circles, gold is being considered. But what actually has happened in the last 8 to 12 months, as we've seen, in addition to the normal buyers of gold, China, Russia, and Kazakhstan, other countries' central banks adding gold, and now adding more gold than since before the gold standard was abandoned in 1971. We've seen Poland, Hungary, Turkey, India, amongst other countries, Kazakhstan, adding gold to their reserves. Now, I think the higher the price of gold goes, then indeed the price of silver will rise more and the gold-silver ratio will fall. And those of you who've been following this channel know I was on SGT Report and I explained this. Most recently, I was on Silver Doctors with James Henry Anderson, and I titled the podcast that we did, Smaulgld gets bullish on silver, and the idea was that it looked like gold had started to break out, and I think we have a confirmation on the breakout. Now, of course, we could see a smackdown, and if gold gets smacked down, well, you know silver's going to get smacked down with it. But if the gold rally sustains itself, there's no jolts to the gold price, then I believe that silver will continue to move higher. And I did say at the beginning of the year, if we did get that $1,500 silver, a $1,500 gold, and it would continue, that my prediction was, when we did the poll, one of the options was, what will silver do this year? And one of them was set the Skyrocket, and I picked that one, and that prediction was for over $20 an ounce. Now, we're not there yet, and in fact, I'm a little surprised how little silver has moved in comparison to gold. But today was an indicator that if we do see these types of moves in gold, what happens is you do see people realize that silver is also, it's not gold, it's not quasi-gold, it's not imitation gold, but it has investment monetary properties and history like gold. And briefly, the thesis has been for years, and I've repeated it many times on this podcast, is the reason gold does better when there's a moderate amount of investment demand. People are concerned, but they're not rushing into any safe haven in any large numbers. They're just concerned. They will buy gold. And that is not just the mindset of the investors, but it's actually the investment profile of gold itself. The demand profile of gold is 40% of the gold that's sold every year is for investment purposes. Some of that is going to investment banks. I think they take up 10% of the offtake of the annual amount of gold. The rest is for institutional investors, ETFs, individual investors. So 40% of gold's demand still would be considered monetary/investment. Another 45% of gold demand is taken up for jewelry. Now, a good portion of jewelry is investment demand. Some of it isn't. Some of it's, I would consider discretionary buy. You buy costume jewelry, 10 karat, 12 karat, 14 karat jewelry. I wouldn't call that investment. It doesn't hurt to have it, but I don't think the people buying it are buying it because they want to protect themselves against some type of future inflation or calamity. They're buying it actually because they have the money to buy it. Then there's 20 karat, 22, 24 karat gold. That's purchased more in the eastern countries, India, China, Thailand, and so on, Pakistan. And that silver, I would say a good portion of that, that gold is investment grade. It is investment grade by definition, 22, 24 karat, but it is purchased for the real purpose for that buying is for investment. Now, some of that investment, though, will be held off on. They will hold off on investing in gold when the price rises. So that's one thing that does keep a cap on the price of gold, is the jewelry demand may get cut off while the investment demand surges because the price is rising. But usually the investment demand is enough to overwhelm whatever purchases are not happening on the jewelry side. And in any event, these markets are controlled by the paper markets, which are investment, more than they are by the physical. Now, having calculated that gold is at least 60-65% investment when you take into account the 40% that's direct investment gold, and then the jewelry demand, which is also gold, you're looking at a good portion of gold would still be viewed as an investment metal, even though they got rid of it as officially as backing the entire monetary system in 1971. Central banks still hold it as a tier 1 asset. It is very much a monetary asset. Now, silver, not so much. Silver is no longer in coins, and silver is not held as a reserve asset and does not have reserve asset status. And only about 10 to 15% of silver is purchased as an investment as part of the overall demand profile of silver. The rest of silver's demand, most of it goes to industry, that's solar panels, electronics, yoga pants, and then jewelry and silverware. Now, most jewelry and silverware you wouldn't really consider an investment, and the investment demand is 10-15%, and the bulk of that is in the United States. Some of it's in India, scattered around the world. The U.S. is probably the biggest investor in silver on a per capita basis. the United States actually buys more silver bullion than all of Chinese citizens, not on a per capita basis, but on an actual amount. So for physical silver, ETFs, physical buying of silver, that is only 10 to 15%. So that's why when there's not a big demand for safe haven, inflation hedged metals, that silver doesn't really do that well. That money goes into gold, and gold kind of plods along. It's not until people start to look at silver as some type of undervalued, I would say, gold substitute, that silver starts to move. Now, the reason silver starts to move is not because money rushes in the same amounts as it does into gold. It's just that when you get some overflow investment dollars, yen or whatever it is, investment into precious metals for safe haven, because the silver market is so small and that investment component is starting off from a small base, it really can explode. And that's what I think could happen. And again, gold has to continue to rise. If it does rise, then I think you will see silver get that bid, and then the gold silver ratio will come down. Now, other things that are causing this rise in gold are not only negative interest rates around the world, the change in the Fed policy, but really what's going on in China. Now, the gold pumpers have been pushing this idea that China is going to crush the dollar, and China's got gold, and the United States is on its last legs, and when China revalues the gold to $10,000 and rolls it out into a state, all a bunch of nonsense. I mean, complete nonsense. Chinese cheerleading from people who generally you would think are free market people. They're cheering on a centrally planned Ponzi scheme, which I've been pointing out for years. And people have said, no, you're not right. China's producing stuff. The U.S. doesn't produce stuff. And I've been pointing out a lot of what China produces is not needed. It's just needed to produce stuff so they can say they produced it, so they can lend money to make it. And then the state-owned bank can lend the money. The state-owned companies can then produce the product, and the state-owned employees can make the product. They can get paid, and then the state-owned company can pay the state-owned bank back. And then that doesn't all work very well, because if they're making stuff that no one needs, like bridges to nowhere, railroads that don't get finished, bicycles that nobody needs or uses, then they have to default. That's okay. Then they just keep piling on more debt. They lend more money. They extend the terms of the loan. They forgive the loan. Whatever they have to do, build more skyscrapers. They have acres and acres of these multi-story skyscrapers. And the Chinese apologists say, well, then they have infrastructure. So when the excrement hits the fan, they're all... No. Infrastructure is useless in a depression. If you have excess infrastructure that doesn't make any cash flow during good times, having infrastructure that you have to pay tax on that's rotting and has to be upkept is not a benefit. A lot of the gold Chinese apologists go on and on about how they've got all this infrastructure and it's a good thing. It's not a good thing. Infrastructure that is not market driven, that you don't need, is a waste of effort. And there's debt that's been incurred to create those buildings, to create those bridges, to create those railroads, that not only are not being used in good times, will certainly not be used in bad times. But then the argument goes, but they have gold, and gold saves everything. Wrong goes star on that one too. The amount of gold that China has compared to the amount of debt they have is ridiculous. At the time, this is back in 2017, I had prepared this chart showing that China had 28 trillion in debt, and then that's really like 60 trillion now. And their value of their gold on reserves is only $800 billion. And that's including, if you add not just the People's Bank of China's gold, but all the gold in the country. You know, the 20,000 tons that everyone says, Sun Tzu, they're hiding that gold. No. So I did count 20,000 tons. The People's Bank of China only had about 1,800 tons at the time, but I added in Hong Kong imports over the last 20 years, Chinese mining production over the last 15 years, Shanghai imports. I got to the 20,000 tons. That was only worth $800 billion back then at, $1,300 an ounce. Even if they 10x the price of that gold, which that's never going to happen. it's not going to do much. It's $8 billion. China is not going to have itself saved from its debt Ponzi scheme just because they've got some gold. And one of the things that I have been saying all along is the collapse of China is what's going to send gold soaring, not this BS about China is going to crush the dollar. First of all, they're not even close to crushing the dollar. They've had to devalue the yuan. It's now over 7 to 1. There's a chart right there. They're not crushing the dollar. They're getting crushed. Multipolar world, de-dollarization, dollar collapse, dollars days are numbered. The gold pumpers went to town with this story. They're right. China is going to cause gold to go higher, but not for those reasons, because when that debt Ponzi scheme collapses, that is going to cause a whole bunch of chain reactions across the globe. People printing money to try to save their economies. There's going to be a massive problem in the economy, and gold will be the beneficiary of it. But it's not because China is in the driver's seat and they make stuff and they're going to get saved and the rest of the world is going to be screwed because China's got gold. And you have people here. That's where your China logic breaks down, because as gold rises, the solvency of the Chinese system rises. No, it doesn't. Gold's rising right now, and China is even worse off right now than it was when the price of gold was lower. Gold could rise to 5K, 10K. It's not going to help China one spit. It could rise to 10,000. I wrote back in January 2018. China has trillions in undisclosed internal debt, unfunded liabilities. They'd have to sell the gold to make any impact at the higher prices. And I wrote here, either way, gold wins, China loses. And that is playing out right now. And the other thing that I've been saying is that, where is it here? Did I just say that one? China, I already got that one. Here's the prediction that I was making all through 2017 and 18. Gold will go up, but not because of any Chinese, Saudi, gold, oil fantasies. Remember gold-backed yuan? China to force Saudi Arabia to accept the yuan. Remember the petro-yuan? That whole story, gold-backed yuan, game changer. Said indeed, gold is more likely to go up because of a collapse of the Chinese debt Ponzi scheme. And that is what's happening. Gold is not rising because China's backing the yuan or because China's forcing Saudi Arabia to accept the yuan and then Saudi Arabia is turning around and buying gold with it. This is the kind of nonsense that all the top gold pumpers were promoting a couple of years ago. The other thing was that China is going to become the yuan, the reserve currency, and crush the dollar. Well, it's gone down since this chart I made back in 2016-17. You can't even see the percentage of yuan as international reserves among central banks. No one wants the yuan. Why? China is a big powerhouse. No. The reason no one wants the yuan is what happened in the last couple of weeks. They'll devalue the yuan. Do you want to be holding that as a reserve asset? No, absolutely not. There's capital controls. Do you want to hold a currency that you can't move? Absolutely not. They have massive debt. You can't trust any of their finances. They actually do have concentration camps up in Upper Mongolia. They run a surveillance society, and they do centrally plan everything. So you really do not want the Chinese yuan, but the gold pumpers persisted, China to crush the dollar. The Chinese yuan is not a desirable currency. Not when they use it. They'll devalue it at will for their own internal purposes. But then here they got the infrastructure. Again, what good is all that infrastructure? Bridges to nowhere, acres of vacant apartment blocks, unfinished railways. What does that do for China when their debt Ponzi scheme collapses? It just adds to the liabilities that they have. What are they going to do with it? It's just going to sit there and rot. They can't export it. They can't make any money off of it. There's nothing you can do with unused infrastructure. But again, the gold pumper somehow figured that was going to make China great and that was going to make US bad, and then gold was going to go up because of that. That's the logic. Now, it's funny. Today, Jim Cramer, I'm not a big fan of Jim Cramer, but he said something. I think I had listed You know, I have all the multipolar world, China to crush the dollar. What are they? The BRICS have had it. My Belt and Road, gold back yuan, Sun Tzu, China to crush the dollar. All this. The other one was China plays the long game. That was another one. Listen to Jim Cramer today. This one's funny. Donald Trump retweeted this one.
Larry, how long would they last for this current sense of we're a long gamer and we do not need the U.S.?
We're a long gamer. China plays the long game. They got about another 2 weeks left in their game. Yeah, China offshore yuan sinks 7 past the dollar. This is one of the main reasons that gold is going higher, because the collapse of China is a big, big deal. Gold back yuan. I mean, the gold pumpers couldn't have gotten it more wrong, just like the silver pumpers. The prices will go up, and not for the dopey reasons that they've been giving for years. And people believe this stuff. And I guess you have to have people believe in some story. Well, here's what came out today. And again, you know, I put these out on social media. Oh, but that's the New York Times. Yeah, okay. Even once in a while, the New York Times can get a story right. You got to remember, the New York Times is in favor of communist China. So anything they say negative about China, you know it's 10 times worse. Yeah, this says here, short on cash. Businesses rely on IOUs to keep the lights on. That's not like the New York Times trying to spread disinformation about China because they don't like China. That's a fact. As the trade war escalates, Beijing needs private companies to pull China's economy out of its rut. But for some, ready money can be hard to find. Yeah, but China has gold. It is unbelievable what's happening there. And it's all been predicted. Actually, I do have to mention that Kyle Bass has been saying this also for years. He actually has his money behind it. He's got some kind of bet on the Chinese Ponzi scheme collapsing. And then the other thing that's going on why gold is going higher, clearly, are you seeing German bonds having a negative rate? You've got the Dutch 30-year government bond yield turning negative. You got this guy here with the Somalian pirate, Dutch government, the bondholders. Look at me. I'm the boss now. I mean, it's amazing when you lend, when you are the lender, when you lend money to a government, in a sense, you're in the driver's seat. They owe you the money. But when you take out a negative bond, you owe them money. That's just nuts. The negative yield. So the point being, the reason a negative yielding bond, one of the things I always say about gold is what you want is real, you want the difference in real rates. So between the inflation rate and the interest rate. So even if a bond is paying 5%, if the inflation rate is 10%, you're getting hosed. So it's good to have gold, even though you're getting a decent bond rate. It's generally gold will outperform the inflation rate. But the other cut against gold is, well, gold's not going to pay you any interest, so you're going to have to rely on that price moving higher. So maybe you do want a 6% bond in a 10% inflation environment because at least you're getting something. Well, in a negative yielding bond, you're not getting anything. And now the cut against gold is totally wiped out, because one of the problems with gold, they say, is not only you're not going to get any interest, but you're going to pay insurance and storage costs. Okay. Well, if you're going to buy a negative yielding bond, you're going to pay to hold that too. Well, at that point, you might as well start holding the gold. Now, silver has got the same. Silver doesn't pay interest, same thing. The only difference between silver and gold on the storage and insurance is it is much more expensive to store and insure gold because of the gold-silver ratio. There's just so much, you know, if it's 80, 90 to 1, the amount of space that it takes up in the vaults is very big. But since a lot of gold and silver investors do indeed, what's the word? Let me just pull up this here. There it is. They do buy SLV and GLD, at which case then you're spreading out those costs over the group, so, or the total pool of investors, so it's not as bad. That about does it for tonight. I want to thank everyone for joining me, and we will see you tomorrow night. And we'll be tracking now the gold-silver ratio. I do expect it to come down if gold continues to rise. I expect silver to continue to rise, but of course, if gold gets a beating, that will stop silver dead in its tracks, but we'll keep an eye on it. Thanks for listening.